current year, the overall GDP is expected to come in at 7.4%. That easily beats the Chinese growth in the current year, which I think is averaging at the moment between 7.3 and 7.2, depending on which quarter you are looking at. And this is how the breakup has come. It is 7.4% in the, 6.5% in the first quarter, 8.2% in the second quarter, and 7.5% in the quarter ended December 31st. So second quarter actually is a very good quarter, going by the sheer growth number. Overall number is 7.4. If you make the average, then it should come approximately at another 7.4 for the fourth quarter also. The residual number is 7.4. This actually gives a very, very good account of the Indian economy at 7.4 over a previous year's growth of 6.9%. But in nominal terms, the current year has grown only by 11.5% compared to 13.6%. In the previous year. The other important number is that although the nominal GDP at current prices has not been revised higher, the real number has been raised higher. That is because prices have risen less this year. The current prices are deflated by a certain factor to get the real growth. Now, the deflator is only 3.8% for the current year. For last year, it was 6.2%. Because prices had risen more in FY14 than they did in FY15. Therefore, the deflator is lower, and that explains why, although the nominal GDP has not been revised higher, or maybe has even been revised lower a bit compared to the budget estimates, you are still getting a real GDP number which is higher. That's the data we have so far. What we need to know is 7.4% is the GDP growth for the current year, and for the latest quarter, it is 7.5%. With that, let me invite our experts. Shubhada Rao, the Chief Economist at Yes Bank, has joined us, as has Sajjid Chinoy, the Chief Economist from JPMorgan. In a bit, we will also be joined by Dr. Pronab. Both of you, welcome. Well, Sajjid, first shot at the numbers. Are they baffling?
Yeah, I'm not sure where to start, Latha. I think what one can glean is, if you look at the last 2 years, what you've seen is a level shift up in the growth rates. Let me tell you what I mean. Market price GDP last year was 5%. It was revised up a week ago to 6.9%. Most estimates for GDP this year were 5.5%. It's been revised up to 7.4%. So the only heartening point is that the trend over the 2 years has not changed. You expected a 50 basis point acceleration in growth between FY14 and FY15. We're getting that 50 basis point acceleration. But in level terms, both growth rates are materially higher. What concerns me is, and I want to commend the authorities for clearly much better measurement, but the only thing that worries me is that none of these indications are consistent with the other high-frequency data that we see in the economy, whether it's imports, whether it's auto sales, whether it's credit growth, that would suggest such robust rates of growth in the last 2 years.
Yeah, I mean, I agree with you, because manufacturing for FY15 has been placed at 6.3 in the third quarter, 9.3 in the second quarter, and 10.3 in the first quarter. Now this, okay, that's at current prices. What is it at constant prices? At 11-12 prices as well, manufacturing has rendered a fair account of itself. I think it comes in at 4.2% for Q3, 5.6% for Q2, and 6.3% for Q1. Now, if you remember right, Ekta, the Q1 corporate results were quite dismal. Yeah. So 6.3% GDP growth looks a little surprising, because you would expect at least a 6.3% percentage growth in earnings. And I don't think that earnings growth were anything as robust as, the kind of nominal GDP growth numbers that these numbers are putting out, which is very close to 11%. Okay, to you, Shubhada, your first take. What's the surprising element in these numbers? Like Sajjid, the numbers are good, but they don't gel with reality?
Yeah. Quite right. I would, in fact, in similar vein to what Sajjid mentioned earlier, the revision from 5 to 6.9 would have implied that high-frequency indicators also should have been doing much better than what they were in this year. Whereas, on the contrary, in the current fiscal year, the high-frequency indicators have done so much better. So the extent of revision in the current fiscal year, which is from up to 7.4, is minuscule, as from 6.9 to 7.4 is minuscule as compared to a whopping 5 to 6.9. So I think there is some serious disconnect between the high frequency indicators, be it a PMI or non-oil imports, and we've discussed it often in the last 1 week as to what high frequency indicators have actually translated on the ground in the current year vis-a-vis a sharp deceleration that we had seen in the last year. So quite simply, yet we need a much more detailed account of what is likely to be released by the end of the month. But insofar as we have the current literature, I think the questions still persist as to how the FY14 numbers have got scaled up to such a magnitude.
Okay. Well, there is another piece of data which is particularly baffling, Sajjid and Shubhada. I have both the real GDP numbers as well as the nominal GDP numbers. Actually, these are GVA at basic prices for the financial sector. Now, we all know 13, 14, first quarter and especially second quarter were the months when there was a run on the currency. One would have expected that the financial sector should not perform so well, but actually we have financial sector performance of 7.7% for the first quarter of FY14, 11.9% for the second quarter, which is the quarter when the rupee took such a bashing, and one would have thought that financial sector should not be growing at 11.9% in real terms, not even nominal, and 5.7% in Q3, which was on the penumbra, on the shadows of a very bad quarter. I mean, these numbers are particularly intriguing. Considering that they are real growth numbers at 10-11 prices, they should have shown at least some moderation, if not actual contraction. Sajjid, what does this mean in terms of... yeah, please go ahead.
You know, I think there the disconnect is not that great. I'll tell you why. Something very unique happened. If you remember the time where policymakers mounted an interest rate defense, the cost of wholesale funding went up very dramatically. So what you saw was a re-intermediation from wholesale funds to credit growth, and credit growth picked up in those particular quarters. So if you look at the old series as well, that trend actually continued, that the July to September quarter benefited from credit growth picking up, where wholesale funding was replaced by financial re-intermediation, and October to December saw very strong deposit growth on the back of the NRI deposit scheme. So I think that in particular it doesn't baffle me too much. It's the general upgradation of manufacturing by 200-300 basis points over the last couple of years, which doesn't sync with capacity utilization on the ground, which is a little more of a disconnect.
Okay. Well, do you want to comment anything on public administration, defense and other services? Those have come in at 1.9% for the first quarter, 6% for the second quarter, and 20% for the third quarter. I mean the quarter that we just put behind us, December 31st. Shubhada, any thoughts on these numbers?
I think the first 2 or 3 quarters we did see some scaling up of expenditure. Expenditure was front-loaded. It's only in the last quarter that we would be likely seeing a compression in expenditure. So public administration and defense largely associated with government expenditure programs. 20 of course looks a bit at a higher level, but on a relative scale between the first quarter, second quarter and the third quarter would have been much higher. So we need to of course look at why the 20% has come. But the direction seems to be quite all right, actually, given the high-frequency data of the government expenditures.
Okay.
All right. Sajjid, you know, I just had a question based on the estimates. You're possibly working with around a 7.4% figure even in the next quarter. Based on what we've seen in this quarter's numbers already, especially from the PSU banks and, you know, the NPLs coming in, do you think that's even likely?
So one explanation and one implication. I think the explanation is, I don't have the numbers, but what Latha read out was October to December quarter saw extremely strong government spending growth. Now we all know that the Jan to March is going to see a very strong expenditure squeeze on the government. And yet if you look at the average numbers, you'd expect Jan to March quarter to also be 7.4% real growth in market prices, so as to get to the 7.4% for the full year, because the first 3 quarters have averaged 7.4. So it's hard to reconcile how if you get this big squeeze in government expenditure in Jan to March, you're still going to get 7.4. The assumption has to be that services growth or manufacturing growth or agri growth or winter crop could be very strong.
No, I'll tell you, I think the secret is out, Sajjid. this 20% growth in public administration in the quarter just gone by, December 31st, is because the year-ago quarter is pathetic. I mean, it just
the
works.
Yeah,
that is the time when the contraction by the Chidambaram Finance Ministry was very severe, which may perhaps explain why this December looks very good. If we apply the same logic that Jan-March of the last UPA government was severely constrained, then probably it won't be very difficult to expect a 7.4% growth in the quarter that we are currently in. Well, actually, Dr. Pronab Sen is joining us now. Dr. Sen, what do you make of these numbers, sir? We are already surpassed China's rate of growth. Dr. Sen? Dr. Sen, can you hear me? No, I think we will have to reconnect. He's not able to hear us, but Pronab Sen should be with us. Remember, he's the chairman of the Statistics Commission and therefore in on all these calculations, will be able to throw a lot of light on these numbers. Okay, Shubhada, do you worry that we could have some problems when the CPI numbers are announced on February 12th? Because if the deflator is this reduced, I don't know whether this will have some impact on the CPI number that will be announced on Feb 12th. Is it likely to be much lower than expected, higher than expected? What is your guess?
I would think the shift would not be a significant delta on account of CPI. We are looking at a 20 to 30 basis point delta on CPI.
Okay.
So we need to exactly compute as to how it's going to affect the final GDP numbers. But coming to the point of, how we, see the last quarter.
Shubhada, I'm sorry to interrupt you, but we have Dr. Sen online. So let's get to him first. Dr. Sen, your take on these numbers, sir. They look too good to be true. We are growing at 7.4%, a shade faster than China.
Yeah, I mean, it's a source of pride, isn't it? Latha, the thing is that I think the rebasing has had some fairly dramatic effects. I think what people have been missing out is that the increase in the share of manufacturing that's happened when we did the rebasing for 2011-12 has had unexpected effects. Because, now on the manufacturing side, in a sense, I think we are using a better definition, which is we are using all value added in manufacturing enterprises, rather than just the production value, which is what we were doing earlier. And clearly what is happening is that the value added component is going faster than certainly going faster than production. The IIP, I think, is still a very good indicator of what's happening to levels of physical production. But value added has other things built into it. I mean, such as what is the relative price between the output and the inputs. So you can have the same output, and if input prices go down, the value added actually goes up. Okay. Then you have other forms of income that corporates have. Treasury income, for instance, all sorts of other things that corporates do, which should have always been included in manufacturing.
No, that's a fair point, sir.
Right?
Sir, that point is taken. Dr. Sen,
what is happening is very clear that the manufacturing growth you are seeing, of that, somewhat less than half, about 40%, appears to be volume growth. And the remainder is on the growth of value added. Okay. Value added per unit of output. Okay. Okay? So it means basically that what we have seen in the last 2 years is not too much volume growth, but quite strong efficiency growth taking place in manufacturing. The real surprise, to me at least, comes from the services sector. Because now, earlier we are using various indicators for services, particularly what's called the GTI, the Gross Transactions Index, which essentially is the total volume of physical goods, which is agriculture and manufacturing. Now we are using tax data, which is actually capturing transactions. So it builds price into it. Now, the tax data has shown, in certain areas, has shown amazing buoyancy. It hasn't shown it all over. And rightly so. I mean, excise, which is linked to the physical output, hasn't done anything. Which is what physical output has also not done anything. But sales tax and service tax have grown strongly. And that's getting reflected in your services estimates.
Sir, but if you looked at the way in which overall tax collections worked both last year and this year, it doesn't give you that much, it doesn't corroborate the strong manufacturing growth that these numbers throw up, don't they?
Well, that's going to be an issue, because what this data would suggest is your corporate income tax should be growing very strongly. Exactly. And if I were the revenue people, that's what I would look at. I think the data is consistent with the excise collection, because IIP and the excise are related, and I think that's coming out fairly clearly. But where the rest of it will get reflected would be in corporate income tax.
So you're saying people are not paying taxes in spite of higher value addition?
Well, no, it's not they're not paying taxes. I suspect what they are doing is that they are under paying the advance tax, and they'll pay the tax later. So I think that over the next month and a half, a lot of corporates are going to see the taxman knocking at the doors.
Okay. Well, Dr. Sen, we have two economists with us who have their own questions and confusions. Why don't I invite them to ask you the questions? Sajjid?
Hi, Dr. Sen. Again, congratulations. I think the methodology is certainly improved. I guess I'm just wondering, how does one sync these real growth rates with other indications in the economy? For example, if in fact manufacturing growth was much stronger, we should have seen non-oil, gold imports pick up proportionately. Auto production, auto sales is quite a clean number. Should have seen a stronger growth in that area. Are you slightly concerned that there could be some disconnect here?
No, Sajjid. Again, let's be clear. All of the indicators you're talking about are linked to the volume of production. Whether you're talking about imports, whether you're talking about auto sales, whether you're talking about excise collection, it doesn't matter.
Right.
The data clearly indicates that volume production has not been high. What has been high is the value addition. So in a sense, for the same value, value of output, you're getting higher value added.
Yeah.
Okay? Now, the GDP is about value added. It's not about the value of production.
Sure.
And that's what you have. So, in a sense, the story is not of an economy which is growing faster because output is growing faster. It's a story where incomes are growing faster because value addition is going up.
But Dr. Sen, you don't produce more number of cars, you produce superior cars. Is that what you're saying? Because auto sales fell.
No,
they were very, very modest.
You produce the same cars at lower cost.
Okay. Okay.
That's what it essentially says.
Okay. Shubhada, you have a question?
Yes, hello Dr. Sen. My question was relating to the sharp revisions in manufacturing and mining. And, intuitively knowing the high frequency indications, we have that ICORs had worsened significantly in mining and manufacturing. And juxtaposing this with the very high numbers revised upward, somewhere there is a very strong disconnect because, productivity had significantly dropped in FY14 on particularly these two sectors. So how does it actually translate into much higher number?
You see, the real problem is in mining that you're talking about.
Yes.
It's not so much in manufacturing. Manufacturing, if you actually look at the company balance sheets, what you would find is that they're actually consistent with what the numbers are saying, which is that the top lines haven't done very much, but bottom lines have been healthy and growing fairly reasonably well. And that's getting reflected in your stock market valuations as well. The problem comes in mining. And in mining, we had been using up to now actually physical data from a limited number of companies which were covered by the Indian, what's it called, IBM, Indian Bureau of Mines. Right? Now what we've done is, from the MCA database, we are getting the results of all mining companies. And the results came as a complete shocker because it really turned things from a fairly substantial negative to a reasonable positive. So the turnaround was massive. So clearly, there's something that's happening in mining which we fully don't understand.
Well, actually, just to
but
give
it's
you
showing up in the company balance sheet.
Yeah, actually, to give you the numbers throughout Q1, Q2 and Q3 of FY14 last year, when supposedly there were a lot of mining bans, the growth in mining has been 0.8, 4.5 and 4.2 last year. And this year, 5.1, 2.4 and 2.9, when actually some of the mines were opened up. So it is a bit of a contradiction. Well, Dr. Sen, finally, we are more worried about what will come on February 12th in the CPI data. Are we likely to see big revisions? What should we brace ourselves for?
Well, on the CPI revisions, I don't think you should expect to see any great revisions at all. Okay? Because this time, at least on the CPI, we're doing a reasonably quick job in rebasing it. And frankly, I really don't see, because ultimately it depends upon what the item basket looks like.
Okay.
And I don't think that's going to change a whole lot. There'll be a few new items, a few other items will drop out. But I don't think you should really
Is there any different weights? We are given to understand there could be higher weights for protein-based food and lower weights for cereals. Anything on those lines?
Absolutely. Absolutely. The weights will change. The weights certainly change. I mean, it's quite clear, for instance, that the weight of food in general will come down.
Okay.
Okay? Within food, you will find the weight of cereals coming down and of proteins going up.
Okay.
So these changes are going to be there. Possibly you will see changes in the of some of the services, particularly education and health.
How will the education and health weights change? Will they get weightier?
Because expenditures, they'll get weightier. In fact, the fastest growing component of household expenditures have been in education and health.
Okay.
Okay, so they're going to go up.
Okay. So food inflation could come down, but services inflation could go up.
Yeah.
All right. That's what we should be prepared for. All right, Dr. Sen, pleasure speaking with you. Thank you very much for joining us, and thank you, Sajjid and Shubhada, as well for joining in this conversation. Well, short point is that hereafter we will be working with a higher GDP number of 7.4% for the current year, over 6.9% last year, but not much change in the nominal GDP. In fact, it's a little lower. If I'm not mistaken, the overall total GDP, nominal GDP that the budget estimated and the fiscal deficit is a percentage of that. That number itself is, I think, lower. I think we were working with a 128 lakh crore. By the new number, it will be 126 lakh crore. So it has to be 4.1% of 126 lakh crore, which means there will be actually a lower fiscal deficit, which the government will have to manage. But okay, those are smaller issues. We are still speaking about a few thousand crores, perhaps. The short point is that we have to reconcile ourselves to a much higher GDP growth. But fortunately, I think we will not get such shockers when the inflation number is announced on February the 12th.